Welcome to Iron Financial. I am the lead analyst, and my mission is incredibly simple. I want to help you forge a stronger portfolio, cut through all the market weakness we're seeing right now, and actually find the structural integrity hidden in the tape. Look, we absolutely do not do fluff here, we do the heavy lifting. Today, in this explainer, we are completely tearing down the Q1 2026 earnings report for Equipment Share, ticker symbol EQPT. We are looking at a company that is attempting to completely rewire the massive, archaic construction industry with tech. And right out of the gate, we have a massive conflict to resolve. They are posting a wildly aggressive 38% top-line revenue growth rate, but they are still printing GAAP net losses. So we need to figure out if this foundation is solid or if the whole thing is just going to collapse under its own weight.
And I'm the market skeptic. I'm here to represent you, the audience. Because let's be entirely honest for a second. In today's market, every single CEO has a pitch deck full of buzzwords promising the moon and back. I really want to know if this is an actual, legitimate opportunity to build wealth or just another highly leveraged trap waiting to crush retail investors.
Exactly. So let's get our hard hats on and go straight to the tape.
Okay, before we even look at a single Equipment Share balance sheet metric, we really have to talk about the macro narrative being pushed here. Management keeps hyping up an $84 billion U.S. equipment rental industry and this supposed super cycle that apparently started back in 2021. I just have to ask, is this massive industry supercycle genuine, or is this just corporate spin designed to sell stock at a premium? I mean, we've heard the term supercycle before in other sectors, and you know as well as I do, it usually ends with a lot of retail bag holders. Hey, it's a completely fair question, but honestly, the capital inflows say it's the real deal. We are seeing a literally unprecedented amount of money pouring into massive infrastructure and advanced manufacturing projects right now. We are talking about mega projects fueled by massive government spending bills, like the CHIPS Act and the broader aggressive push for the onshoring of American manufacturing. Entire supply chains are being completely rebuilt domestically. The sheer size and complexity of these job sites are expanding rapidly. But here is the absolutely critical problem, and exactly where Equipment Share claims to find its edge. The construction industry is notoriously, painfully archaic. It has completely lagged behind almost every other major sector when it comes to technological advancement and basic productivity.
And you have to understand, that lack of technology has a massive, highly quantifiable cost. Look at this number, $1 to $2 trillion. That is the estimated amount of lost productivity in the construction sector globally, simply because they do not have a common operating system. Wait, $1 to $2 trillion? That's not just a rounding error on a spreadsheet. That's literally the GDP of a medium-sized country, just vaporized by basic inefficiency? That is exactly the scale of the inefficiency we're talking about. You have massive contractors out there running multi-million-dollar fleets using dry erase whiteboards, fragmented Excel spreadsheets, and literally sticky notes. That translates to real, hard capital burning up on the job site every single day. Imagine paying daily rent on 5 massive excavators, and they're just sitting completely idle on the wrong side of a 50-acre site, all because the foreman doesn't know where they are or who currently has the keys. Equipment Share's entire foundational argument is that they are actively building the operating system to capture that lost $1 to $2 trillion. Think about it. Only a select few companies out there actually have the logistical footprint to rapidly deploy thousands of heavy machines. And if you can successfully layer a proprietary tech ecosystem right on top of that iron, you are looking at a fundamentally outsized growth trajectory.
Now, let's drill down into the actual Q1 2026 financials. Here is your massive top-line headline, 38%. Equipment Share delivered a 38% year-over-year revenue jump for the first quarter, bringing their Q1 total revenue to an impressive $989 million. Now, we are benchmarking this against the massive $4.65 billion trailing 12-month scale. Hold on. A 38% top-line growth rate in a heavy industrial sector is incredibly aggressive. We aren't talking about some nimble software-as-a-service company scaling in the cloud here. This is moving heavy iron. Just for some context for the audience, the industry average growth right now is hovering right around 3 to 4%, so they are absolutely blowing past their peers. But my immediate question is, growth at what cost? Because this leads me directly to my ultimate question for this entire deep dive. Is this a generational market opportunity, or is this just highly leveraged tech hype? I mean, practically anyone can grow their revenues by 38% if they are willing to take on enough debt and just buy market share. So is this growth structurally sound, or is this a fragile house of cards built on variable rate debt and flashy Silicon Valley buzzwords? That is the exact question we are going to tear apart today. We are going to break down this balance sheet piece by piece to find the truth. We absolutely need to verify the structural integrity of these earnings. We have to see if the core margins actually hold up under pressure, or if the sheer cost of this aggressive expansion is basically eating them alive from the inside out.
And to do that properly, we don't just look at polished, glossy investor presentations, we go straight to the raw SEC and Globe Newswire tape. The raw financial summary breaks this down incredibly cleanly. When we compare the 3 months ended March 31st, 2026, directly against 2025, total revenue hit that $989 million mark. But listen, the actual composition of that revenue is what dictates the true quality of the earnings.
Right, exactly. Because just selling equipment is a nice one-time pop, but renting equipment? That builds a durable, recurring revenue base. And looking at the breakdown, I see the equipment rental and services operations segment is making up the absolute lion's share of that top-line number.
That's the core differentiator right there. Let's isolate those two segments to see the engine at work. Rental segment revenue surged from $556 million in Q1 2025 all the way to $764 million in Q1 2026. That is a massive 37% surge year over year. And if you look at it on a trailing 12-month basis, that rental segment is sitting at a staggering $2.93 billion.
And meanwhile, equipment sales still grew a respectable 23%, moving from $145 million to $179 million.
Yeah, but the rental growth is the true core engine here. And it's being driven heavily by massive customer demand in the industrial sector, heavy infrastructure, and particularly data center construction. These are incredibly complex job sites that require immense, totally reliable fleet availability. They aren't just calling up a yard to rent a single backhoe for the weekend. A massive data center project needs entire fleets instantly. And frankly, they strongly prefer to rent rather than deal with 10 years of painful depreciation headaches and complex maintenance logistics. They aren't just renting a machine, they are renting an entire logistical operation.
And here is the metric that absolutely proves the embedded earnings power of this specific model: 55%. This right here is their trailing 12-month adjusted EBITDA margin specifically for their mature rental locations. Okay, we need to be clear here. Let's define mature, because the fine print in the footnote states a mature site is a full-service rental location that has been open for greater than 24 months. Correct, and that detail is absolutely vital to understand the strategy. When they first open a brand new location, it actively drags on their current earnings because of the immense heavy lifting happening in those first 2 years. You are laying out capital to secure prime real estate, staging the initial multi-million-dollar fleet, hiring specialized diesel mechanics, and spending heavily on local marketing just to pull stubborn contractors away from entrenched local competitors. But once a location hits that golden 24-month maturity mark and the local reputation is solidly established, the margins absolutely explode to 55%. Management also notes a return on invested capital, or ROIC, of 16.5%, which they confidently claim is the highest in their peer group. This really proves the structural integrity of their geographic footprint. As their newer, expensive growth locations age into these high-yield mature locations, we should see massive built-in margin expansion.
Okay, I hear you on the margins, but I want to talk about the elephant in the room. The CEO and the president, Jabok and Willy Schlacks, keep aggressively pushing this construction tech narrative in every press release. They constantly claim they aren't just a traditional rental yard, they are a tech company. They call it the T3 platform. Look, to a lot of investors, it sounds like a whole bunch of corporate jargon explicitly designed to trick Wall Street into giving a tech multiple to a heavy industrial stock. What actually is T3? Is it real?
It's a totally fair pushback. Let's clearly define it so we know what we're actually buying. T3 is their proprietary telematics and overarching operating system. It is essentially a live operating layer that actively connects the physical equipment, job site access control, servicing schedules, and overall utilization. So instead of a stressed foreman walking a 50-acre site for an hour looking for a specific bulldozer, T3 pinpoints it instantly on an iPad. It actively verifies who has the digital keycard to even start the ignition, and it flags the maintenance team if the engine is running hot long before it actually blows a gasket and halts the project. They claim this is what makes AI actually meaningful for the construction sector, turning raw, messy job site data into vastly improved machine uptime and much smarter service routing. It completely decommoditizes their fleet. It's not just iron anymore, it's smart iron.
But listen, as investors, we honestly don't care about the flashy tech unless it actively translates into real bottom-line dollars. And the quarter event summary highlights the real-world return on investment of T3.
First off, contractors utilizing the system are reporting a 10 to 20% increase in job site efficiency, which primarily comes through massive labor savings and significantly reduced machine downtime.
And here is the real kicker for the financials. Customers who actively use T3 end up spending 6 times more with equipment share. That is absolutely massive pull-through. I mean, if the software successfully locks the customer into your specific ecosystem, your lifetime customer value just skyrockets.
Exactly. That is the very definition of a wide economic moat. Furthermore, Equipment Share actually owns the largest U.S. telematics manufacturing operation outright. They are fully vertically integrated, perfectly combining the physical hardware on the machines directly with the software running on the contractor's iPad. This tight integration is exactly how they lock in that lucrative recurring revenue.
All right, lead analyst, you've painted a really beautiful, highly bullish picture so far, but it's time to pivot and look for the cracks in the armor. Because when I finally look at the actual, undeniable bottom line, things get really messy really fast. Let's contrast their massive, highly touted $399 million adjusted core EBITDA against the cold hard reality of a $29 million GAAP net loss for Q1. Come on, how do you possibly reconcile a business supposedly throwing off nearly $400 million in adjusted earnings while simultaneously losing $29 million on a generally accepted accounting principles basis? And this is exactly why we drill down. You absolutely have to understand the bridge from GAAP to non-GAAP to know if management is simply hiding operational failures behind clever accounting tricks or if these are entirely legitimate, forward-looking growth expenses. Let's tear it open.
Okay, let's unpack those specific non-GAAP adjustments. To me, the biggest, most glaring red flags are the stock-based compensation and the startup costs. They conveniently added back $17 million in stock-based compensation expense that was specifically related to equity awards granted to the CEO and president. They call them the IPO Founders Awards. Wall Street notoriously hates it when companies sweep stock-based compensation under the adjusted rug because, let's be real, it is real shareholder dilution. You are effectively giving away pieces of the company to the founders and pretending it doesn't cost the retail investor a single dime. Look, dilution is absolutely a valid concern, yes, but you have to remember it is a non-cash expense today. As a trader, actively analyzing their ability to actually service their debt and fund daily operations, I care far more about the operational cash flow. Now, the second major adjustment is the $50 million in new market startup costs. These are the heavy upfront investments required for their rapid geographic expansion, literally opening 22 brand new locations in Q1 alone. Yeah, but startup costs are just a reality of running the business. If you are always growing, you will always have startup costs eating into your profits. That's true, but Equipment Share argues they are fundamentally unique as the only large-scale rental provider fully focused on organic growth rather than acquisitions. Adding back that $50 million gives us a transparent, clean view of what the core existing business is actually yielding right now, before the penalty of that aggressive future expansion. Remember that 55% mature margin we talked about? That $50 million expense today is exactly what buys you that 55% margin tomorrow.
Fair point. But let's talk about the heavy lifting happening on the cash flow statement. We cannot ignore that this is an incredibly painfully capital-intensive industry. You have to constantly buy heavy machinery. In Q1 2026 alone, their gross rental capex was a staggering $328 million. That is a massive amount of cash going straight out the door just to buy iron.
Right, it is heavy, but you also have to realize they systematically sell off older depreciating fleet equipment, which effectively brought their net rental capex down to $213 million for the quarter. Over the trailing 12 months, net capex was $616 million against $1.8 billion in gross purchases. Understanding the actual asset lifecycle is key here. Selling off older equipment isn't just an accounting trick about reducing net capex, it actively keeps the fleet incredibly young. A fresh, modern fleet drastically reduces ongoing, unpredictable maintenance costs and deeply appeals to those premium, top-tier contractors who simply cannot afford a breakdown on a mega project. You literally can't grow top-line revenue in construction without aggressively buying the best assets.
But buying those premium assets requires debt, and taking on debt in a higher interest rate environment is the ultimate portfolio killer. Why on earth should a retail investor be comfortable with any significant leverage when borrowing rates are this punishingly high? Which brings us perfectly to the balance sheet defense. Listen to this. Despite the heavy capex we just discussed and the incredibly rapid geographic expansion, their actual net leverage decreased year over year. As of March 31, 2026, net leverage dropped to 2.8x, down from 3.2x a year prior. It's highly manageable because this specific debt is fundamentally backed by hard, tangible, revenue-generating physical assets, not just some speculative, intangible corporate goodwill.
Okay, 2.8x is manageable, I'll give you that, but it's absolutely not risk-free. Agreed, it's not risk-free.
But it is supported by phenomenal liquidity. They are currently sitting on $1.6 billion in total available liquidity. That includes a massive $1.27 billion available on their asset-based revolving credit facility, plus $329 million in cold, hard cash. The balance sheet absolutely has a solid foundation to weather a severe economic storm. Now, if you really want to know how they are miraculously achieving this massive 38% growth while simultaneously deleveraging the balance sheet, you have to understand the specific blueprint of their ON program. This is their absolute secret weapon. It is an incredibly capital-efficient, totally organic growth model that completely bypasses the need for terribly expensive mergers and acquisitions.
Walk me through the actual mechanics of this. How does this actually work for the everyday retail investor trying to understand the business model?
Think of it exactly like an Airbnb, but for heavy machinery. Step 1. Third-party investors actually front the cash to buy a brand new bulldozer. Step 2. EquipmentShare takes that physical equipment, fully outfits it with their proprietary T3 telematics, and lists, deploys, and manages it entirely on their own platform. EquipmentShare completely handles the messy maintenance and essentially hands the keys directly to the contractor. Step 3. When that equipment successfully rents out for a daily rate, the revenue is simply split between that third-party investor and EquipmentShare. And to truly understand the sheer massive scale of this program, look at their original equipment costs under management. The total managed fleet is worth a jaw-dropping $9.06 billion, but EquipmentShare only owns $3.93 billion of it directly. Wow. Okay, so the OWN program alone accounts for $5.05 billion of the total fleet. That means over half of their entire revenue-generating capacity is essentially kept completely off their direct balance sheet. Yes, that is the absolute genius of the structure. This is brilliant next-level balance sheet management. By utilizing this heavily oversubscribed OWN program, they dramatically reduce their direct depreciation hits and slash their massive interest expense. They get the incredible revenue-generating capacity of a $9 billion mega fleet while only actually carrying the heavy debt and depreciation of a $4 billion fleet. It is literally an 8x more capital-efficient organic model compared to a traditional corporate buyout or a heavy M&A growth strategy.
Okay, but there is absolutely no free lunch in the market. What is the actual cost of this supposedly capital-light model? Because I dug into the tape and I found it buried in the cost of revenues, $217 million. That is the staggering amount paid out to those third-party OWN program participants in just the first quarter alone. That's a 41% massive increase year over year. As a skeptic, I view this as a massive, ongoing, and potentially fatal long-term margin pressure. Instead of just paying a fixed, predictable interest rate to a bank, you are literally giving away top-line revenue forever. It's a calculated trade-off. Yes, absolutely, the ON program payouts shift expenses right up into the cost of revenues, which mathematically lowers their gross margins. But you have to see what it does. It fundamentally de-risks the entire company structure. Think about a traditional old-school rental company. In a severe economic recession, if their equipment just sits completely idle in the yard gathering dust, they still have to make their massive fixed debt payments to the bank every single month, which is exactly what drives them straight into bankruptcy. But with EquipmentShare, if an ON program asset doesn't rent, they simply don't pay out the revenue share, zero. It magically converts a fixed, potentially lethal debt cost into a highly flexible variable operating cost. That is the definition of absolute structural safety. Finally, we really have to zoom out to the broader macroeconomic environment to see the whole picture. The Courtier summary correctly identifies that we are currently operating in a stark K-shaped recovery within the broader construction sector, meaning different subsectors of the exact same industry are moving in completely opposite directions at the exact same time. Exactly. That's the critical macro divergence we are tracking right now. The bottom arm of the K is residential single-family home construction, which is heavily lagging and hurting because elevated interest rates are absolutely crushing mortgage demand. But EquipmentShare doesn't play in residential. They are firmly positioned on the top arm of the K. They aggressively focus on large, highly complex job sites, heavy infrastructure, advanced manufacturing, and massive data center builds. These specific sectors are absolutely booming right now. They're heavily insulated from standard consumer interest rates, and they are fueled by massive, unstoppable corporate and government capital inflows.
All right, it is finally time for the ultimate showdown. Let's weigh the overall risk versus reward. On the bullish side, we undeniably have a rock-solid foundation. 55% mature location EBITDA margins absolutely proving incredible unit economics. We have 34 to 38% year-over-year revenue growth that is completely outpacing the rest of the industry. And we have an incredibly capital-efficient, tech-driven organic growth model via the OWN program, keeping debt incredibly manageable. But on the bearish side, we absolutely cannot ignore the real cracks in the armor. You still have 2.8x leverage in a very, very tight credit environment. You are still printing painful GAAP net losses, partially due to massive IPO founder dilution payouts that hurt retail. And you have a rapidly growing $217 million quarterly liability in third-party owned program payments payouts that is perpetually eating right into your gross margins. And that brings us to the final verdict. Listen, EquipmentShare is clearly not your grandfather's rusty construction rental yard. They are aggressively using proprietary technology and an incredibly clever off-balance sheet financing structure to rapidly take massive market share in an $84 billion industry. The top-line growth is just undeniable, and the mature branch margins absolutely prove the fundamental model works beautifully once that initial heavy lifting is finally done.
But you have to be completely comfortable with the GAAP losses and the incredibly aggressive capital expenditure required just to keep this heavy iron engine running. Make no mistake, it's a high-growth, extremely high-stakes play in a notoriously capital-intensive sector.
Which leaves us with the ultimate question for you, the investor. Knowing the leverage, knowing the blazing growth rate, and seeing the massive technological moat they're actively building, is this stock the strong foundation your portfolio needs to cut through market weakness right now? You need to do your own heavy lifting, run the numbers for yourself, and decide if EQPT belongs in your strategy. Thanks for joining us for this explainer on Iron Financial. Stay sharp out there.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.